How does inheritance tax compare to other taxes? Have you ever wondered how inheritance tax stacks up against other types of taxes? It's a fascinating topic that touches on wealth, property rights, and how we view taxation in society. Inheritance tax is a tax imposed on the transfer of wealth when someone passes away. This tax specifically targets the assets that a deceased person leaves behind for their heirs or beneficiaries. Unlike income tax, which is based on earnings, or sales tax, which is charged on purchases, inheritance tax focuses on the wealth that has already been accumulated. This makes it unique because it taxes capital rather than ongoing economic activity. When we look at the timing of these taxes, inheritance tax is levied only once, at the moment of death. In contrast, income tax and sales tax are ongoing. This one-time nature means inheritance tax can influence how wealth is passed down through generations, rather than affecting daily financial decisions. Now let's consider the economic impact. Income and sales taxes can change how people work and spend their money. Inheritance tax, however, affects how individuals think about saving and passing on their wealth. From a libertarian viewpoint, which emphasizes strong property rights and minimal government intervention, inheritance tax raises some concerns. Libertarians argue that this tax interferes with an individual's right to transfer property freely to their chosen heirs. They believe that property rights include the right to bequeath assets, and taxing this transfer infringes on that right. Moreover, inheritance tax can be seen as a form of double taxation. Wealth that has already been taxed when earned is taxed again when it is passed on. This perspective suggests that inheritance tax may discourage saving and investment, which could hinder economic growth and personal freedom. However, some libertarian thinkers acknowledge that inheritance tax can help limit the concentration of wealth and power across generations. They argue that a modest inheritance tax could support a fair competitive environment without excessively violating property rights. When comparing inheritance tax to other taxes, we see some distinct differences. Income tax is often viewed as a tax on personal effort, while sales tax is seen as less intrusive since it taxes consumption. Property tax, which is charged annually on property ownership, is sometimes accepted by libertarians as a necessary cost of government services tied to property. In contrast, inheritance tax is more controversial. It directly taxes the transfer of property that someone has already owned, which can conflict with the deceased person's final wishes. In practical terms, inheritance tax can help reduce wealth inequality by redistributing assets that might otherwise accumulate across generations. Yet, from a libertarian perspective, this redistribution comes at the cost of infringing on property rights and individual liberty. Libertarians generally advocate for minimal or no inheritance tax, favoring voluntary transfers and private agreements over government-imposed wealth redistribution. In summary, inheritance tax is distinct from other taxes, as it targets wealth transfer at death rather than income or consumption. It raises unique concerns about property rights and individual autonomy, making it a sensitive issue within libertarian thought.